Private credit has hit the headlines recently, and your pensions and Roth funds are about to be wiped. Let me explain. Suppose there's a company A. It makes 50 to 500 million in revenue. Sounds like a big business, right? But it's burning through cash. It can't manage its money, and it needs more just to keep the lights on. So it goes to a bank and asks for a loan. The bank looks at company A's books, sees it's already drowning in debt, and says, no, too risky. No traditional bank in America will touch it. Company A is now distressed. Nobody will lend to it. It's stuck. Now here comes private equity. PE walks in and says, I'll help you get the money, but there's a price. You sell me your business at a discount. Company A has no other option, so it sells. Now PE owns the company and calls a private credit fund. PE says to the private credit fund, give a loan to company A. I vouch for them. Now private credit needs money to lend. So it goes to your pension fund, your Roth account, your insurance company, sovereign wealth funds, retail investors, and says, give me your money. I'll guarantee you 8 to 12% returns. Safe. Secured. Senior debt. First in line if anything goes wrong. They hand over billions. Private credit now lends that money to company A at 10 to 13% interest. Now remember, a normal healthy business borrows from a bank at 5 to 6%. Company A is paying double because nobody else would touch it. The loan is locked in for 5 to 7 years. Your money is now inside company A. Now here's what company A actually does with that money. It doesn't hire more people. It doesn't build a better product. It doesn't grow revenue. It takes the new loan and uses it to pay the interest on its OLD loans. Borrowing to pay borrowing. It's like taking a credit card to pay the minimum on another credit card. On paper, the loan looks fine. Company A is making its payments, but in reality, it's just delaying the day it runs out of road. And then the road runs out. In February 2026, Trump attacks Iran. Oil prices across America nearly double. Gas goes from $2.98 to over $4 a gallon in 6 weeks. Inflation jumps back to 3.3%. The Fed says consumer sentiment has hit the lowest level since 1952, lower than the 2008 crash, lower than the pandemic. People stop spending. They stop eating out. They stop buying things they don't need. And company A, whose entire business depends on the American consumer walking through the door, watches its revenue fall off a cliff. Now, company A can't even pretend to pay interest. And at the same time, investors see this danger and are lining up to pull their money out. But the private credit fund doesn't have cash lying around. All of it is locked inside 5 to 7 year loans to companies like company A. So to pay investors back, the fund is forced to sell these loans to someone else. And when you're a desperate seller, buyers smell blood. A loan that was sitting on the books at 91 cents now gets sold for 60 to 70 cents. Maybe less. And here's the thing about company A's assets. This isn't a factory with machines you can auction off. A lot of these companies are software businesses. Try selling the code base of a failing SaaS company. Try finding a buyer for a customer experience platform whose clients are leaving. The collateral that was supposed to make this loan safe is practically worthless. So the fund sells cheap, takes a loss, and the investors who didn't get out in time, they're stuck holding a loan that's now worth a fraction of what they were promised. $20.8 billion in withdrawal requests in 1 quarter. Blue Owl's tech fund, 40% of investors wanted out. They got 14 cents back on every dollar. Blackstone had to put 400 million of its own cash in just to stop the bleeding. And the best part, these management companies, Apollo, Blackstone, they don't actually lose. They sit on top and collect fees. The funds below them are separate legal entities. Fund blows up, parent walks away. Heads they win, tails you lose. And on April 13th, 2026, Wall Street looked at all of this and built a credit default swap index, a tool that lets hedge funds bet on exactly this scenario, private credit defaulting. When the same banks that helped fund this entire system turn around and build a product to bet against it. That's not a warning, that's the bell. Part 2. How private credit is managing their risks. Follow for the update.